So let me talk you through a little bit of the fundamentals. This is sort of the blocking and tackling of commercial finance. But what I find with many small businesses, nonprofits, community organizations, you've never had this program. And you don't know how to look at yourself through the lens of your lender. So I'm hoping to give you a takeaway today which will give you a little bit of perspective of not only how you might be viewed, but maybe how you can improve that view for the benefit of your organization going forward. So let's start with the 5 fundamental C's: capacity, character, collateral, capital, and conditions. Now, capacity I characterize as the ability to repay debt. That might be measured in cash flow. It might be measured in terms of looking at the ability to repay the debt as you agreed to pay it. And the focus here is the ability to repay. There's no point in having a deal that you cannot match the terms on. You know, when you deal with collateral lenders, where collateral becomes the priority, you always put yourself in harm's way, because if you don't have the cash flow, and then collateral becomes uppermost in the lender's mind, in which case it might be repossess or foreclose that collateral. So capacity is how you gauge your ability to service the debt. But what goes with it, just as important, and which is given much too little condition by many lenders, is character. Character is that intangible. And character I look at as the willingness to repay. I have borrowers that I've dealt with in the last 40 plus years that I could tell you they would repay me before they put food on their table. You know, what you want is somebody who's got that work ethic and who will tell you openly what their situation is and can be trusted, because the first rule of lending in my book is you never do business with a person you can't trust. And so character is trust. And how do you know it? Well, you look at the track record. If it's a consumer, you might look at the credit report, but you look at such things as job stability, look at their income, look at the situation that defines how do they operate. I can tell you, in a tough economy, I'm very focused on looking at my customers who are coming through this tough time and surviving. Now, they might have taken a hit or two, they might have hit a speed bump. My job is to help get them over that, if they're willing to be open and honest with me. But people that can get through a tough time and survive are people I want to do business with in the good times. What scares the heck out of me are the people that have never been tested. And there are plenty of folks in the room, most of whom don't have gray hair yet, but they're working on it. And it's like they've only been in an up economy. Now we come down to the third element, collateral. Collateral ought to be, at best, a distant secondary source of repayment. The primary ought to be your capacity, your cash flow. Because if you become a cash flow lender, you can always look at how do you tweak the cash flow with the borrower to help get them through a tough patch. If you're only a collateral lender, you become dependent just as much as they are on the value of that collateral holding up. So collateral is a good thing, but collateral should never, ever be the primary source of repayment, okay? The fourth condition is capital. Capital is your skin in the game. It could be equity, it could be sweat equity, but well, there's a value you've committed to the deal. I mean, why would you come to me to borrow 100 cents on the dollar? And you have nothing in the game yourself. You have to have a vested interest. And what you have to understand is the capital is your cushion, not my cushion. Because if you have no capital, and it's all down to collateral, and your cash flow disappears, you will be wiped out. It's just real simple. Think about this. The average bank loan loss reserve is 1% of their outstanding portfolio, which means if you're going to live within that reserve you've established, you have to be right 99 times out of 100. That's a 990 batting average for you baseball fans. And that's a hell of a batting average, which means that you've got to be kind of tight on the front end to preserve that average and not blow through it. And so what you look at is the more capital somebody can commit to a given organization, a given project, the more skin they have in the game, the more they're doing their part to reduce the risk for themselves and for you as the lender. Now, these first 4 categories represent the 4 categories, the 4 factors over which the borrower has some degree of control. The 5th one's the wild card. That's conditions. That's the one you cannot control. So if you're in a great economy and things are just booming, you know, your challenge may be to get your respective piece of the market. But you know, sometimes people miss some of those conditions because if things are really good, it may hide a problem you've got. For instance, in a growing market where the entire market is growing by 10%, and you're growing 5%, you're losing ground. You just don't see it yet. You can look at the issue of conditions in terms of how does that affect all the other conditions you have here, all the other categories. And so you have to say that the best I can do is I can try to control 80% of what influences the total credit picture I'm presenting to a lender. And you have these 5 factors, and I want you to give these 5 factors equal weight. And this is where you need to be honest with yourself. If you recognize each of these factors as a true strength, give yourself 20 points per factor. If it's okay, but not a strength, 10 points. If it's clearly not something that's going to add to this picture, and it might be a real takeaway in some cases, 0. I don't require negative points here, okay? And if you take a look and being honest with yourself and you say, okay, if I take these 5 factors and I apply this little grid to it, the total number of points I will accumulate is my probability of getting success in the credit application I'm about to make. What do you do when your score is under 50%? Well, you have to be just as honest as saying, which of these factors can I do something about? I can't control conditions. They are what they are. So you have to focus on those other elements to figure out how can I present a better picture to my lender. And here's the thing. If you're making an application for credit to a commercial bank that's following this blocking and tackling fundamentals, then if you approach your lender and say, I've put myself through this process, my own due diligence on me and my business, and here's how I see me. And here's the things that are strong, and here's things that are not so strong, but you know, here are the mitigating factors that offset those weaknesses. And I want to see if you're interested in doing business with me, given this as a starting point. Because you've just done the initial step of homework for the bank. And the fact that you can recognize the impact of these 5 factors on your business, on your organization, is a real healthy way to open up a dialogue. You may not be able to get what you want right now, but what you want is the banker not to tell you no. What you want is the banker to tell you not yet. If you're a responsible lender, you do your borrowers no favors if you just gloss over this stuff. You've got to get the borrowers to see the same thing the same way you're seeing it. And to understand, there are times when saying no or not yet is the best answer you could have given somebody. And you have to be able to understand that if you take these 5 factors and take them to heart, there is no deal for no purpose, for no size, and no place that you can't apply this to. It is universal. But you know, the funny thing about universal truths and basics is when people get caught up in the excitement of a hot economy and a great deal, and they let emotions overcome their own sense of logic, you get away from this stuff. And I guarantee you, you'll always come back to this and kick yourself if you got away from these basics. Repayment risk is just an assessment of the ability to repay the debt that's been proposed. Collateral or construction risk is looking at the value of collateral, particularly if you've got collateral that will grow in value, or your expectation at the time it is, to simply take these 5 factors I've given you here and see how many apply to each one of these risk factors. And the answer is all of the above, just to give you the end of the story. So the issue here is when you look at assessing risk, whether it's from an investment you're going to make or it's a loan you're asking somebody else to make, if you're asking mom for a family loan, teach mom how to do this on you, because the worst thing in the world is to not be able to pay mom, okay? Seriously. And so what you want to do is be able to have as your takeaway here, how does this apply to you, your business, your organization? If you understand it, the second thing you need to do is make sure your banker understands it. Because one of the most dangerous things in the world is an ignorant lender. Because an ignorant lender, when things go bad, becomes a panicky lender. And things always go bad in that scenario. So, I've given you some tips.